Hey, Samir.
Wait, what time is your?
Hi, Samir. Great, you're on.
Hey. Hi. Hi, Raj.
There's a bit of background noise.
Yeah, there is a bit.
Perfect. Well, good evening, everyone. Thank you very much to attendees who've joined us. As is always the case, I'm going to give people about 30 seconds to stream in. During this time, I will run you through our customary disclaimer. So first things first, the weekly forum is strictly for our subscribers. It's meant purely for informational purposes, does not constitute investment advice. It is not the opinion of Smartkarma, but that of our insight providers. And last, but quite importantly, Chatham House rule apply to all our webinars, which means please do not share on social media or any other public forum without express permission. With that in mind, I will also now very quickly run you through some of the ideas that we discussed in previous weeks, just to give you a flavor of what we bring to the table week after week and how we weave in some of our core thematics into the ideas that were discussed. So last week, we paused and recapped two previous ideas. The first was Straits Trading, which is a great value stock here in Singapore that will benefit from asset crystallization when they list out ARA, their crown jewel asset. We also looked at Pacific Textiles, which is a Hong Kong listed textile manufacturer, but with a growing footprint in Vietnam and a potential M&A target too. We also sort of sidestepped and then took a look at an emerging area of interest for capital markets, which is Internet of Things, IoT devices. And there were two IPOs that we, shone the spotlight on. The first was Tuya, where we were extremely positive, and it's been a terrific debut. And we also took a look at Aztec, which we were a little bit more mixed on, especially given sort of the pre-IPO history for the company, but nonetheless, quite sort of interested in the prospects. And then in our usual thematic section, we took a look at emerging market energy and how it's the most unloved sector amongst fund managers out there and how positioning is at record lows. The week prior to that, we took a look at Cromwell Reit. This is a European REIT that is listed in Singapore, yielding about 8%. And there's a special situation that has unfolded here that we wanted to bring to attention, where it is going to get included in global REIT indices, which should lead to a significant re-rate and improvement in liquidity. We also spoke about Tencent and about risks that no one is talking about. So a lot of people are talking about potential regulatory risk around Tencent, but we were talking more about potential lockup expiry and NASPers coming to market and selling down stock again. And we also spoke about, with the sell-off in global tech, what happens next? Where does attention shift? So the theme you'll notice is that every week we sort of divide the forum into three sections. But the first section is always some sort of a hidden small or mid-cap gem that has been surfaced by independent research on Smartkarma. The second, we try and look at a bigger company, a large cap of some sort, where there is an interesting angle. And we then, in the third section, focus our attention on some sort of a thematic. So without further ado, let's look at what is on the agenda for today. So the first thing is a value investor stock idea with a very good catalyst. And here we will be looking at Hong Kong listed Oriental Watch. And I'm really happy to introduce Samir Taneja very shortly. He's the research provider who's focused on this name. Second on the agenda today would be a very high growth Chinese electric vehicle company called Xpeng, which is listed in the US. And last but not the least, in our thematic section, we will look at the resurgence of IPOs in Philippines and a very clever way to position to benefit from that. So without further ado, Samir, welcome to the forum. I'll just unmute you. Perfect.
Hi. Yeah.
Hi, Samir. If you want, you can turn on the video too.
Sure. Just give me a moment. Right.
Okay, so before we get into Oriental Watch, just maybe you can take a brief 10, 15 seconds and introduce yourself to the attendees. Maybe just your background. Where did you cut your teeth in terms of, looking at markets?
Sure. So yeah, I started out on the sell side back in 2003, looking at the commodity sector. I covered metals and mining stocks in India. Thereafter, I joined the buy side in 2007 and joined a tiger cub called Kelusa Capital. It's a very bottoms-up focused fund that did long-short equity in Asia. Was with that setup for about 10 years, and then joined a smaller fund which did research, which does research on equities that are mid and small caps. So I was with the setup for 3 to 4 years. Now I'm an independent research provider. I write for the Smartkarma platform.
Great. Now, the idea that we will discuss today is Oriental Watch. And, I'm sharing my screen here. And, this is an idea that you've written about for quite a long period of time. There's sort of a lot of green circles on my chart here, which shows you've been bullish and positive for a very long time.
Right.
And what we've done also is just put together a few very brief bullet points on this. So I will run through these, and then Samir, I'll just ask you a couple of questions.
Sure.
We keep the forum just very, very short and sweet and very punchy, almost like an open mic. So this is a value investor, dream stock. It's a company that you've tracked for a long time. Just here and now, the key angle here is that actually the growth of the business has been exceptional. Their stores in China where they sell luxury watches, they're registering about 120% year-on-year same store sales growth. And the Hong Kong business, which struggled quite a lot last year, first due to protests and then due to COVID lockdowns, hopefully will sort of reopen and also start contributing. And I think you've displayed through your work on the Smartkarma platform that, first of all, nearly 70% of this company's market cap is cash. So that's about $1.75 per share.
Yeah.
I think the current share price is about $2.65 or $2.70. Right. So that's a lot. In addition, they have $1.40 of high-end watch inventory, which is sort of a fairly liquid asset at times. They also have another $1.40 of real estate in Hong Kong. And then on top of all of these, of course, they sell watches, and they've got a profitable business where they make close to $100 million of profits too. So if you add all of those numbers up, you'll notice that it's a lot more than the current share price. But I think your thesis doesn't stop there, Samir. I think you talk a lot about how this company has consistently paid out a lot of its profits in dividend. In fact, they've committed to a payout of more than 100%. Right. And that equates to a 10% dividend yield. And I think you've gone on to even sort of assert that the company might pay out more than this, so more than 100%. So they will dip into the cash reserves that they've got to pay out more in dividends. And lastly, you have alluded to the fact that with the founder having passed away recently and his son having taken over, there might be some interesting changes afoot, from a corporate succession standpoint also. So those are some of the key points. So the question I have for you is, frankly, first of all, just how long have you followed this company?
Oh, I've followed this company for a good 4 years. And I've been in touch with senior management here for quite some time. This is a company that sort of has kept its word in general on, things that they would do, so they had committed to paying out more than 100% of their profits as dividend, and they did so. It's easy for companies to sort of backtrack on what they've said, and therefore there are a lot of instances where companies have promised a lot and not really delivered on their promises, but this is one of those companies which has done so. And it just to encapsulate in short what the thesis here is that last year, if you look at their profits, there were about 100 million Hong Kong dollars, but the same-store sales growth has been extremely strong here. In fact, in the last 5 months, it's sort of tracked over 40% same-store sales growth. And China, which is, I guess, a large proportion of the same-store sales now, because the Hong Kong market has suffered due to COVID-related restrictions, has been growing at over 100%. So it's very likely that the company will deliver extremely strong results, and so 100% of that out as dividends. And in addition to that, they also have committed to pay from their cash pile. So they have 850 million Hong Kong dollars, or 1.75 Hong Kong dollars per share of cash on their balance sheet. So there is a certain proportion of that will also, sort of the shareholders will see that as well.
All right. Sameer, I think that's quite clear now. I think the second question for me was, I think they did a very important corporate action quite recently, where they bought.
Correct.
Was it about 15%?
Yes. So the company bought about 15% of outstanding shares. This was back in October 2020, and it was done at 3 Hong Kong dollars per share, the buyback. So they spent close to 300 million Hong Kong dollars on the buyback, and in spite of that, there is still there's still a substantial amount of cash still on the balance sheet.
Got it. Perfect. Okay, so sort of let me just repeat that. So very, very recently, they bought back 15% of their market cap at $3 a share. And the current share price is actually lower than what the company just paid to buy back its own shares. And as a result of this buyback, I guess the management's own stake in this company has increased. Sameer, off the top of your head, do you sort of roughly remember how much do management and founders now own in the company?
So the management and founders now own about 37% of the company post the buyback. Prior to that, they owned around 30% of the company.
Understood. And last question from my side is, let's talk a tiny bit about succession. So, when did the proprietor pass away, and who's taken over, and what could potentially happen over time?
Right. So the founder, Mr. Yung, he was in his mid-80s, and he just passed away last month. And Mr. Yung's son, Dennis, has taken over as the chairman and the CEO. He was already the CEO, actually. So he just took over as the chairman of the company. And now he has since he has been CEO for a fairly long time, and sort of been managing relationships with Rolex and Patek Philippe, who are the major which are the major brands that this company sells watches for. And so, he's been managing these relationships for the past 5 to 7 years. Of course, he himself is in his mid-50s, but he has some time to go. But this is one of those companies which could potentially also be a target for the brands itself, if they want to control their supply chain totally, or private equity firms, because there's deep value in this sort of a company.
Got it. Samir, just one last brief question before we let you go. We've got an attendee asking us, do you know the reason why they did a partial buyback in 2020 instead of just declaring a bigger dividend or a usual market buyback?
Right. So there's a substantial amount of cash that still is on the balance sheet. And this business still makes very, very good cash flows. And so the owners wanted to, up their stake so that they would get paid more dividends. So this is one of the reasons why they did this buyback. They did not buy the company out totally because they still want to remain listed. As a lot of these distributors like their brand name to be recognized and be listed on the stock exchange. And hence, just the partial buyback. A large dividend is something that they never really wanted to commit to because their rationale is that, investors will just, take the large dividend and then sell their stock. Mm-hmm. So they are happy to, pay from the cash pile in addition to the profits that they make in parcels, I would say.
Got it. It creates better long-term alignment.
Right. Yes.
Fantastic. Well, Samir, thank you very, very much. Really enjoyed having you.
Right. Great.
Pitch this very quickly. Thanks.
Thank you. Thanks everyone, and have a great day.
Speak soon. Bye. Fantastic. So we'll sort of quickly move on to the other two sections, but feel free to send in any questions on Oriental Watch or the other ideas at any point of time, and we'll sort of pause and answer them. Okay. So the second idea today that we're looking at is a company called Xpeng. This is the ticker is XPEV. As you can guess from the ticker, they're an electric vehicle company. It's listed in the US market. The market cap is about $17 billion US. So this is a large stock. It trades $800 million a day, so it's very liquid, and there's clearly a lot of sort of interest and trading. Victoria Lee, who is a top-rated China autos analyst, covers this sector and also the stock. Victoria is actually very positive on this company. She sees it as the best way to play the Chinese electric vehicle story. So let me sort of briefly run you through her thesis here. But before we do that, just sort of take a quick look at the share price chart. So, the share price tripled between October and November in about a month's time last year, where it went from about $20 to $60. And since then, it's pulled back to about 30, 35. And this is where, Victoria is actually sort of really pounding the table and getting more aggressive with her call. So she thinks that this market weakness is an opportunity. Another reason why the stock is potentially weak is that we're approaching, or we have already crossed the IPO lockup expiry. So, basically what this happens is, typically for a few months post the lockup, the early investors cannot sell, but after that they can. And the market fears a large amount of shares hitting the market all at once. And that typically causes share price weakness post IPO. So that could be a second reason. But thirdly, also, there is a very strong product momentum. So they're rolling out better car models in the coming 2 months. And she thinks that you're going to get a bit of a gap as the company shifts its models, where production will be impacted negatively in that transition. So Feb and March will be weak sales months for the company. And again, some investors might be sidelined during this time. So all in all, this Feb-March period creates a bit of an opportunity for investors who like high growth businesses, who are positive on EV and so forth. So let's take a quick look at some of the other important aspects. So first of all, if we look at growth rates of this company leading up to Jan 21, this was the fastest month-on-month growth rate company amongst all the peers. And when we look at the peers in China, you've got, of course, you've got Tesla Shanghai, so the Chinese production arm of Tesla. There's NIO, and then there's Li Auto. So those are sort of the four big players, right? And amongst all of those, Xpeng was actually the fastest grower. Their navigation guided pilot technology, so NGP, as sort of analysts refer to it, is actually seen as China's best. This is across multiple reviews. They've also launched the LFP battery models. So LFP is the lithium iron phosphate batteries. This is sort of the latest technology in EV batteries. And the good news with this is that actually they're a bit cheaper and they're more durable and the performance is better. So they're sort of better across the board. And because they're cheaper, the car manufacturers can actually lower the car price. And there's quite a lot of volume sensitivity. A lower price attracts a lot more buyers. And very quickly, you know, just since 3rd of March, 20% of all new orders have shifted to these LFP battery models, which is great. The Q4 guidance from the company was very solid. Their gross margin is about to turn positive. As you can sort of see from that chart, things are inflecting as scale comes into the business. Then they're working on a new car model, which is P5, which will be looking to launch in April and could be a very, very big success. Now, this is a very, very interesting company based on the founders and the shareholders. So if we look at shareholders, Alibaba, Qatar Investment, Xiaomi, Foxconn, IDG, they're all sort of, they own more than a third of this company. So very important, big strategic shareholders. Also, in terms of founders, some of the founders came from one of the largest auto companies, Guangzhou Auto, and then two of the management have also come from NIO. So it's really got a lot of things going for it. It's not that well understood as a company at the moment, which creates opportunity. And you know, we've been looking very, very closely at consumer reviews as well. This is a little video. I'm not going to run through this, but I do recommend if any of you guys are interested in this sector or space and have further questions, write to us. We'll forward these slides, and then you can sort of look at these some of these videos in more detail too. Terrific. So if no further questions on this, I'm going to just move on to the third and final thematic discussion, which is around an IPO resurgence in Philippines. Now, Philippines is one of the smaller markets here in Southeast Asia. It's been out of favor for a few years, but just to give you a sense, if we go back 6-7 years ago, it's probably the hottest market in Southeast Asia. And for the last 2, 3, 4 years, really, it's been very quiet. There haven't been any major IPOs. All of that is changing in 2021, where actually the IPO pipeline in Philippines is probably the biggest it's ever been. I think it's going to be a record year based on guidance from the exchange and media sources. There's a couple of IPOs live at the moment or sort of in the pipeline already. One of them is Mon Nissin. We'll talk about that very briefly after this. There's also another REIT in the market that's sort of Double Dragon. And as I mentioned, this is just the start of many more IPOs that'll come this year after a long time. So I'll just briefly talk about Mon Nissin because it is quite an entity. First of all, it is the market leader in this market for instant noodles, biscuits, drinking yogurt, and oyster sauce with sort of branded products, and it's a real cash cow. The second very interesting thing here is this is the largest ever IPO in Philippines. They're raising about $1.3 billion. And actually, the single IPO will be more than the entire last 2 years of issuance combined. Third, in addition to the noodles, biscuits, yogurt, and oyster business, there's a hidden business, which is the alternative meat business. So they make about $315 million of revenue and $48 million of EBITDA from this alt meats business. Of course, this has been a very sort of buzzing and trendy topic, right? We've all looked at Beyond Meat and Impossible Foods and so on. So similar to those, they have a business line which is called Quorn, Q-U-O-R-N. And instead of making plant-based beef or plant-based lamb or seafood. They're focusing on a alternative to chicken. They have about 100 different SKUs, and I think the chicken business is the one that's expected to grow fastest. Also, when we look at the top 5 brands, for instance, in the UK, Quant really dominates with about 67-68% share. This is data that has been presented as part of the IPO prospectus. Now, this company, Monde Nissin, will be probably the only Asian listed company with clear and sizable exposure to alternative meat, which, as I mentioned, is very topical and trendy. It fits in with a lot of sort of ESG mandates, and a $300 million revenue line for this particular business cannot be ignored. So we think Monde Nissin will structurally benefit from that scarcity factor too. And this is a company that's going to survive and grow into a much bigger branded business over time if execution continues, given sort of the trends that we see. But I think given this resurgence of IPOs in the market, we've also been looking at hidden plays, hidden ways to benefit from it. And one of our sort of favorite ideas in that space is the Philippines Stock Exchange. So, for those of you who have invested in exchanges before, you'll know that, first of all, these are monopoly businesses, right? Each country typically only has one major exchange, and that exchange tends to do very, very well over long periods of time because of that monopolistic position. Secondly, we think that the Nissin Monde IPO and all the other IPOs this year will really, really move the revenue line for the PSE. As you know, IPOs lead to listing fees, which is quite chunky and lumpy, but they also add new market cap and new companies that investors can trade into the market. So you have 2 benefits. You get that chunky revenue, which is once off, but then you also get extra market cap and hence more trading commission revenue over time, or clearing revenue that these exchanges can avail. Now, when we look at this exchange, even in its worst year, so last 3 years, if we look at it, they've consistently made 45 to 50% net margins. This year, they have more than $3 billion of IPOs in the pipeline. Their own market cap is only about 230 to 40 million. They pay a very, very nice dividend. In fact, this chart was made before it went ex-dividend yesterday. So they paid out 8 peso out of 150 peso share price. So about 5.5% in a single dividend payout. It's a very, very cheap stock. In fact, it could be the cheapest exchange in the world if you adjust for the amount of cash that they have. And also, what's quite interesting and important is that it's probably the last emerging market exchange in Asia where bigger strategic exchanges could take a stake. So, let me expand on that, right? If you look at, let's say, Singapore Exchange as an example. If Singapore Exchange wants to do some inorganic transactions, some sort of M&A to improve its growth prospects, where do they go? It's hard for them to expand into China and India now. Malaysia and Indonesia are also hard for various political reasons. Thailand has actually evolved and become very, very big. In fact, it's bigger and more liquid than Singapore. So you're really only left with, Philippines and Vietnam. But when you look at Vietnam, it's an expensive market now. So seriously, Philippines probably stands out as the only market where bigger exchanges could participate through the PSE. So I think it'll be worthwhile to take a quick look at some of the metrics on PSE on the platform. Great. So let's go into the analytics section. Perfect. So these are the financials. If we go back 10 years, right, you look at this period from 2011 to 2014 was just bumper. Revenues were growing, profits were growing, margins were growing. I mean, this company had a 57% net margin in 2014. If you look at the few years after that, it's sort of been a bit stagnant, right? It's been flattish because, as I mentioned, right, the market fell out of favor. It was quite expensive after 2014. There was political change. Duterte took over. You didn't really have any big IPOs. And now we're on the cusp of all of that changing all over again. The market's very cheap. It's ignored and so forth. And PSC follows. Then if you look at cash flow, this red line is free cash flow. I mean, it's mind-boggling how much free cash flow this company makes every year. If you look at balance sheet, it's just squeaky clean. They really don't have any debt, or you know, it's a net cash business. I think it's great to look at profitability. So over the last 10 years, gross profit margins of this company have been anywhere between 70% and 86%. I mean, as a business owner, it's very, very hard to have a business model that generates that kind of gross margin. And then when you look at that sort of what goes between gross and net, actually, it's very little, so the operating expenditure is very low. About 50 to 60% of their revenue makes its way to the net margin. Again, that's exceptional. Lastly, you're going to see why returns have fallen. So this is things like return on equity, return on capital. Actually, there's nothing alarming here at all. The reason returns have fallen is because they've generated so much cash, which is sitting on the balance sheet, and they've done nothing with that cash apart from just paying some dividends. So if they decide to do a buyback or do a smart acquisition or invest in R&D, actually the return ratios are going to inflect the right way. So as we look at PSC, the last and most compelling thing is to look at what the share price has done. So when we look at it from a 5-year perspective, I mean, this thing used to be close to 300 pesos in 2016. Today it's at about 150 if you adjust for the dividend. So it's halved, and that makes it a very interesting and very compelling entry point. And at $240 million market cap and exposure, just very simple, clear exposure to one of the most exciting emerging markets here, it sort of sits very favorably compared to a lot of other ways that you could choose to invest in Philippines. So with that, we're sort of at the end of the forum. If there are any other burning questions, please feel free to ask. Otherwise, you can always post discussions on the platform, send us messages, do send us feedback on how you find the forum, if you would like us to look at different ideas. Also, I do remember now, I had a question that came over the last week, which was how do we invest in some of these smaller ASEAN markets? And it's a bit harder, but there are a lot of local brokers. So Poems or Philip Securities, for example, here in Singapore, allows access to all of these markets. But there are several more brokers now that do that. And we would strongly recommend, reaching out to these brokers. You can even sort of let us know, and we can connect you to some of them if that helps. But that's how you can get access to some of these exciting markets that are, not that well at the moment. Okay, so no further questions. So I'm going to say goodbye to everyone today and look forward to speaking to you all next Thursday. Thanks, bye.